While everyone is busy chasing overvalued tech, defense, and railway stocks, India's biggest hidden monopoly sector just quietly opened up in a brand new way for retail investors. Welcome to this explainer. Today, we're diving into a really fascinating draft scheme information document that just hit the market. We are talking about a sector that's totally woven into the future of the Indian economy, yet it's kind of being ignored by everyday investors who are distracted by all the noise in the broader market. The stakes here are high, and the potential for long-term wealth creation is seriously significant. But, as always, the devil is in the details, right?
So what exactly is this next big sectoral boom we're looking at? Well, it's the Indian insurance sector. The macroeconomic story here is just incredibly compelling. Think about it. India is a severely underinsured nation with this massively rapidly growing middle class. The sector is fundamentally booming. But the real question is, how do you, as an everyday investor, actually capture that growth? That brings us to the core of today's explainer, the brand new ICICI Prudential BSE Insurance Exchange Traded Fund, or ETF. This new fund offer is designed to be the country's very first insurance-specific index fund. It's aiming to give retail investors a direct, passive route to literally own this massive growth engine. But before we get into the exact mechanics of this specific fund, we really need to address the elephant in the room.
Section 1. The Stock Picking Problem. Look, it's incredibly tempting to look at a booming sector and try to pick the winning horse. You might be sitting there thinking, why don't I just buy shares of LIC or HDFC Life or SBI Life and just call it a day? And honestly, that is a perfectly valid question. The problem, though, is that to truly analyze an individual insurance company, you can't just glance at standard profit and loss statements. You have to decipher these incredibly complex balance sheets. You need to understand highly specialized niche metrics, things like value of new business margins, combined ratios, and solvency margins. It's literally a completely different language. Contrast that sheer complexity with the safety and simplicity of buying a sectoral basket. Instead of betting your hard-earned money on one single company's management or one specific product mix, a passive sectoral basket allows you to just own the entire industry's growth trajectory. Simply put, if the Indian insurance market grows as a whole, your basket grows. Section 2. Inside the new NFO. Okay, let's dive into this and decode the exact product mechanics directly from the draft scheme information document. We want to know exactly how this tool is built and, more importantly, how you can access it. Looking right at the document, the absolute standout number is this: 1,000 rupees. That is the minimum application amount for issuing units during the new fund offer. This is a massive selling point, honestly, because it dramatically lowers the barrier to entry. It allows retail investors to own a proportionate slice of the entire Indian insurance sector for less than the cost of a dinner out. It totally democratizes access to a sector that usually requires heavy capital to build a well-diversified portfolio of individual stocks. Now, timing is everything with these things. The NFO window is highly specific. It runs from July 20th to July 28th. But here is an absolutely critical operational detail. Because this is an exchange-traded fund, you absolutely must have a demat account to invest. If you don't have one, you'll likely have to wait for a fund-to-funds or FOF route. Now, an FOF doesn't require a demat, but it often comes with slightly different expense ratios. So please don't make the frustrating mistake of trying to buy this ETF without the right account setup. Let's move on and see how this is actually built by looking at what the ETF tracks. The benchmark here is the BSE Insurance Total Return Index. The document defines this as a float-adjusted market cap weighted index. But what does that actually mean in plain English? Basically, it means the index takes the top 12 insurance stocks derived from the broader BSE 1000 universe. These companies are strictly classified under the insurance industry. The float-adjusted market cap part? That simply means the weight of each company in the index is based on the total value of its shares that are actually available for public trading. So it's a pure passive reflection of the sector's heavyweights, and it gets reconstituted semi-annually. And this brilliantly illustrates exactly what you're buying into. Looking at the data, you can see right away this isn't some equally divided pie. The index is incredibly top-heavy. Just the top two players alone, SBI Life and HDFC Life, make up nearly half of the entire index weight. Add in ICICI Lombard and Max Financial, and these top four pretty much dictate the vast majority of the fund's performance. You are essentially buying the biggest power players in the Indian insurance landscape in one single, highly concentrated trade. Section 3. Pros, cons, and risks. Now, transparency is absolutely key here. We've talked about the pros, but we've got to confront the stark reality mapped out in the document. So the crucial point is right here on the official Riskometer. Notice how the needle points firmly and unequivocally into the very high risk category. The AMC is definitely not mincing words here. While it's certainly safer than picking one single stock, a purely sectoral ETF like this is still highly volatile. Your entire investment is tied to the fate of one single industry. If regulations change abruptly, or if the insurance sector takes a macroeconomic hit, your portfolio is going to take a direct hit. No question about it. Digging deeper, the document outlines several specific dangers we really need to highlight. First up is portfolio concentration risk. Because you're heavily invested in just 12 stocks, and predominantly those massive top 4 we just discussed, any trouble in those specific companies is going to drag down the whole fund. Second is tracking error. While the fund manager's entire goal is to perfectly mirror the BSE Insurance Index, real-world factors like fees, cash balances, and market illiquidity can actually cause the ETF's actual returns to deviate from the index it's tracking. Finally, you always have to account for general market volatility and, crucially, regulatory changes, which are massive factors in a heavily compliant industry like insurance. But on the operational side of the risk and cost ledger, there is actually some good news. The load structure is very straightforward. The document clearly states there is an exit load of nil for units sold through the secondary market on the stock exchanges. This means the mutual fund company won't penalize you for selling your units. However, do keep in mind that standard brokerage costs, transaction charges, and statutory levies will still apply when you execute a trade through your demat account, just exactly like any regular stock transaction. Section 4, the final verdict. So we've covered the macro opportunity, the mechanics, the exact stocks inside the index, and the very real risks involved. Bringing it all together, the takeaway is pretty clear. This ETF is highly suited for aggressive investors looking for a tactical allocation in their portfolio. It's a specialized tool to capture a very specific macroeconomic thesis, the idea that India's insurance sector is going to boom over the next decade. Because of that, it realistically requires a minimum 5+ year time horizon to weather the inevitable volatility. Conversely, if you're a conservative beginner looking for safe, guaranteed returns, or you just want a core foundational fund for your retirement, this very high-risk sectoral bet is likely something you should probably avoid. It is a really powerful financial tool, but just like any sharp tool, it has to be used correctly. You now have the complete, unbiased picture directly from the source material. So I'll leave you with this question. Does the ICICI Prudential BSE Insurance ETF actually fit into your specific risk appetite and your 2026 portfolio strategy? Take some time to think about your personal timeline, your tolerance for volatility, and your underlying belief in the Indian insurance story. Thank you so much for joining me for this explainer, and I highly encourage you to dig into the draft documents yourself before making any major investment decisions. See you next time.